In this video, we're going to be going over the 10 a.m. candlestick anatomy theory. This is one of the best models that you can trade inside the marketplace to catch consistent moves day in and day out. If you guys are unaware of the candlestick anatomy theory, it's simply an easier way to gauge the daily bias, right? Instead of looking at the daily bias from a daily perspective or a weekly perspective, you can use the 4-hour time frames and anticipate that 4-hour power of 3. So as we can see here, we have the 10 a.m. candlestick and we have this 4-hour power of 3. When we have this opening price, we come lower, we sweep this previous 4-hour low, and then we see this push to the upside, taking out that previous 4-hour high. Inside of the lower time frames, we can gauge this by identifying a higher time frame point of interest or an area of liquidity. Right here in this schematic, this is a lower time frame. Whether you prefer the 15-minute or the 5-minute, whichever one, this will be your lower time frame point of view. So as we can see here, we have that 10 a.m. opening price. Then we see this drop to the downside, tapping into this point of interest or area of liquidity. What could be a point of interest? A point of interest could be a higher time frame fair value gap, like a H1 or H1 fair value gap, or an H1 or H4 order block or breaker on the higher time frames, or even a 15-minute fair value gap, breaker, order block, whichever one you guys see inside the marketplace. But the main proponent is this point of interest is that area of support inside the marketplace where the marketplace reaches down into, or it could be an area of liquidity. What is this area of liquidity? Well, this could be the previous 4-hour low. This could also be a previous session low. Since this is the 10 a.m. 4-hour, the previous session could be either the London session or the Asian session. So we come lower, taking out either a point of interest or tapping into an area of liquidity. And then after tapping into that point of interest or area of liquidity, we want to see that break a structure to the upside, signaling that market structure shift. And as we can see here, and after that market structure shift, we can take our position here, whether this may be a mitigation or breaker block or fair value gap or order block, whatever it may be, we can take our trade here, riding it higher for a continuation for that 10 a.m. reversal. Right, so we had that opening price, which is that accumulation as the 10 a.m. candle opened. Then we had that manipulation lower into this point of interest or area of liquidity. Then following that manipulation, we got this breaker structure, which is our indication that price is now leaving that point of interest or area of liquidity, which once price leaves this area, it should not want to revisit back lower. So then we can take the longs here based off of any area of support, fair value gap, order block, whatever, to then catch that distribution back above an area of liquidity, which in this case was this previous 4-hour high. It could also be a previous session high. It could also be an area of resistance, maybe a 1-hour or 4-hour fair value gap or order block, whatever it may be, as long as it's at least a 2 to 1 R, right? This is very powerful because 10 a.m. is a specific time to where the algorithm really starts to pick up volume, right? This happens after the 8:30 news, as well as this happens after that 9:30 stock market opening price. So that time period between 10 a.m. to 11 a.m. or 10 a.m. to 12 p.m., this is a good window to then catch those really nice reversal moves or potential continuations of the trend. And when we are trading the 10 a.m. CAT model, we want to be trading it on indexes because the index market opens up at 6 p.m. So that 4-hour candlestick ends up being 10 a.m. as well as this happens 30 minutes after the stock market opens. So after that influx of volatility comes in, the marketplace starts to die down and price action becomes a lot cleaner, but there's still a lot of volatility. So there's a lot of things that actually goes into our favor as to why the 10 a.m. CAT is a very good model. Now we're going to head on to the charts and I'm going to show you not only live trades, but also some examples to where you can take notes and start implementing it into your charts today. Me and my brother SpecTrades have come together and launched SparkTrain University. Coming from humble beginnings, Train has changed our lives and we're able to escape poverty and now live a life of abundance in only 1 year. If we could do it, everyone watching this video can do the same, and it does not have to take long. And that's why we developed a framework that anyone can use inside of SparkTrain University that gives them the same results that we got, if not even better. And we want to hold every student's hand inside of SparkTrain University until they are profitable. Stop going about it alone and let me and my brother be your new mentors. And for this video, I'm opening up 5 slots for the next 5 people to join SparkTrain University. You can just click the first link in the description to join SparkTrain University. We're looking at the NASDAQ here on the 4-hour time frame, and when it comes to candlestick anatomy theory, we can use the previous 4-hour candlestick as a way to gauge where the next 4-hour candlestick is about to go. So as we can see here, we have this 6 a.m. 4-hour candlestick, and the 10 a.m. 4-hour candlestick is just about to open. So we can use what happens during this 6 a.m. 4-hour candlestick as a way to gauge where the next 4-hour candlestick is going to go. This is a very simple way of identifying daily bias using this one simple trick. So as we can see here, how we can gauge where the next 4-hour candlestick is about to go is looking at the little pieces inside the marketplace that tells you the whole narrative. So as we can see here, what can we identify inside the marketplace? Well, we can identify this 4-hour bearish order block. What is this 4-hour bearish order block? This 4-hour bearish order block is a point of interest, right? This is an area of resistance inside the marketplace where we're anticipating resistance or sellers to come into the marketplace and drive the market lower. And as you can see here, as the marketplace reached up into this 4-hour bearish order block, this last up close candle, followed by this change in state of delivery lower, right? As price came back up into this last up close candle, it was met by this rejection wick, right? We talked about this in previous lessons, but the rejection wick is simply a lower time frame power of 3, where we see the opening price, we come higher, tapping into this level of resistance. Sellers were then met as we tapped into this level of resistance, and then sellers aggressively sold, bringing us back into the opening price. Usually when we have a rejection wick, it's like a slingshot. So it comes up higher, 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 and then once sellers are met, it is aggressively sold, right? So this is a great indication to anticipate an influx of volatility soon to come into the marketplace. Let's go down to a lower time frame and get more context. We're down on the 1-hour time frame. We just had this 4-hour order block, which we just talked about, but we also have this 1-hour bearish order block. This is a high probability order block because this is the last up close candle following this drop to the downside, but before that we had this liquidity sweep. So obviously price came up higher, swept these previous session highs, which looks to be these London session highs. So we came up higher, swept these London session highs. Following that, the marketplace could not push any higher, and instead it saw this massive drop to the downside. And we came up into this order block once, could not break higher, dropped lower, and we're coming back into this order block once again. So obviously this is marked out as a strong high. This is marked out as a strong high, and we just came back up here once again, tapping into that same order block. If you guys see the pattern here, we are creating lower lows inside of the marketplace. So from the 4-hour perspective, we were inside that 4-hour order block, and from that 1-hour perspective, we not only identified that 1-hour point of interest, which is this 1-hour order block, but we identified market structure inside the marketplace, which we can identify that we're making lower and lower prices. So this is a good way to gauge daily bias without having to overcomplicate it, right? We have the point of interest, then we have the market structure, which is indicating to us that we're going lower and lower prices. Now we can identify a draw on liquidity, and we can see here a draw on liquidity could be right here, which is this 2 a.m. candlestick, which is this London session low, as well as we can identify the draw on liquidity down here as this Asia session low, right? We do also have order blocks here as well as potential areas of drawn liquidity or inefficiencies where we could reach back down into. So obviously we came up higher into a level of inefficiency by this order block. Price could not push higher, so indicating to us that we're going lower. Market structure is indicating to us that we're going lower, and we have drawn liquidity below us, which is in the form of this previous session low an order block down here, as well as these Asia session lows below us. Let's go down to the 15-minute time frame and get more context. We're down on the lower time frames here, which is the 15-minute, and the 10 a.m. candlestick is about to open up. What we want to see from that 10 a.m. candlestick opening up is we want to see a manipulation to the upside, tapping into some type of level of inefficiency, or maybe taking out some area of liquidity, maybe this prior 15-minute high, whatever level of inefficiency or liquidity there is for that manipulation move. And then we want to see that drop to the downside, targeting these liquidity pools. The 10 a.m. candlestick is about to open up. Let's see what happens. We then see this drop to the downside, taking out this London session low, obviously indicating to us that we could potentially seek lower prices, right? We're obviously taking out previous lows, but we're failing to take out previous highs. This is indicating to us that the marketplace is comfortable going lower, so we should anticipate lower prices, as well as we can identify this bearish fair value gap here on the 15-minute as an area of inefficiency to where we could anticipate a manipulation move back up into this level of fair value gap here, targeting back below this previous low and even lower down below this Asia session low. So what I'm going to do here is I'm going to put my limit order as price taps into this bearish fair value gap on the 15-minute. Stop loss just back above these highs here. Pretty safe stop loss, targeting back below the Asia session lows for over a 3.5 R. Let's see how this trade then plays out. Price comes up, taps us in. And just like so, very, very solid. We had that manipulation to the upside, back up into this inefficiency, as we can see here, marketed by this 4-hour candlestick. We had that manipulation to the upside, back up into this inefficiency. And then we had this distribution to the downside, targeting back below these lows here as the area of draw on liquidity. On to the next lesson. So we're on the 4-hour time frame here. We're looking at the S&P 500, and some key things we can take note of is obviously this liquidity sweep that we came up higher, taking out this previous steady high, as well as we can also take note of this bullish order block below us. We can take note of this bullish order block below us, as well as this liquidity sweep of the previous steady high. Right now, we're in kind of low probability conditions between an area of resistance above us and an area of support below us. So when we're in this position to where we have a resistance above us and a support below us, we want to go into lower time frames and get additional context to support whether it's going to go higher or whether it's going to go lower. Let's go down to a 1-hour time frame and see if we can get more context. So now we're on the 1-hour time frame, and we have this 4-hour candlestick to our left, which is that 6 a.m. 4-hour candlestick. The 10 a.m. 4-hour candlestick is about to open up here, and we can identify this previous 4-hour candlestick high, as well as this previous 4-hour candlestick low. So as we can see here on the 1-hour time frame, we still look like we're kind of inside of this doji formation. So we're not really getting too much context here inside of the marketplace, but it's important to take note that we did take out liquidity, and following taking out liquidity, we did see this drop to the downside, taking out this previous low. So for the most part, even though it's still low probability conditions, I'm leaning more so towards lower prices, because after taking out this area of liquidity, we made an effort to take out the previous low. So obviously, when we take out a high inside the marketplace and then we take out a low inside the marketplace, this then creates a dealing range, and as price comes back up into that 50%, this is a high probability chance that we could see a continuation to the downside. So as we can see here, we took out the previous daily high, followed by we took out this previous session low, creating this dealing range here. And right now we were just inside of the premium level. So in terms of anticipating higher or lower prices, based off of the context I just gave, we're leaning more so towards lower prices. Let's go down to the 15-minute time frame and see if we can get more information. Now we're down on the 15-minute time frame here, and as we can see here, things are looking a lot more clear. I hope you guys can see this. So we came up higher at around 8:30, taking out this previous daily high. Following taking out this previous daily high, we had this market structure shift to the downside, taking out this previous session low. So obviously this is indicating to us lower prices. So boom, that's a point for lower prices. Now, after taking out this previous high, then take out this previous low, this is a dealing range. So obviously this pullback inside the marketplace is simply just a retracement to come back into a level of premium to potentially continue to see lower prices. Because once we've established this high here, followed by that market structure shift to the downside, taking out this previous low, price has no effort to come back up into this high. Instead, it will remain inside this premium to then continues to see lower prices. And we can obviously identify this bearish for value gap as a level of resistance inside the marketplace as 10 a.m. opens up to then capitalize on our short opportunity. So 10 a.m. is about to open up here on the next 15-minute candlestick. What I'm going to do here is I'm going to put my limit order at the opening of this fair value gap here. Stop loss back above this high here, targeting back below this previous low for a 2.5 R below this previous 4-hour low. Very, very good setup here, right? We've identified that liquidity sweep here. Then we identified that market structure shift. Then we seen that price took out this previous session low, indicating to us a bearish market structure, creating this dealing range. So as price comes back up into this premium level, you want to take shorts based off of that 10 a.m. power of 3, where we have that opening price, see that manipulation higher into this bearish point of interest to then see a push to the downside back below this draw on liquidity, which is that previous 4-hour low. Let's see how this then plays out. 4-hour opens up, we see that push to the upside, back up above into this bearish for value gap, reaching down below these lows. We come back up into this bearish order block here. If you guys were to scale into your position, this would be a very good scaling. And just like so, reaching back below this low for over a 2-to-1 R. Very, very solid. So that's going to be it for the video. I hope you guys got a lot of value out of this video. And if you want to support me further, make sure you guys like this video, subscribe, and share this with a fellow trader and spread the knowledge. I'm Arkham. Be safe.